In this video, I want to talk about the massive disruption in global container shipping that we've seen since the beginning of the pandemic last year, and specifically how has this impacted and how is it continuing to impact global metal markets. If we look at the chart here, it shows a weighted average for major trade routes for hiring a shipping container, and it almost looks like the chart for Bitcoin. That you can see that the freight rates have spiked considerably over the last year, and that's really been accompanied by delays in global shipping and also availability of shipping containers. And what's really been driving that? Well, it's been the rolling lockdowns we've seen over the last year. So it's the big increases in demand for household goods as individuals have been locked down at home. Also, the big boost in demand for medical supplies in the early stages of the pandemic. And the asymmetry of those trade flows, particularly from east to west, has led to a lot of empty shipping containers in the places when they're not needed or in the wrong places globally. There's also been port congestion related to that unexpected boost in import demand by some countries, and also from COVID-related restrictions around ports that have impacted port activities. In terms of the impact on metal markets, we see in the concentrate market, obviously, zinc and copper are the standout metals where you can see that treatment charges have really been impacted over the last year. And that's largely because of mine disruption we saw last year and because you've seen smelter capacity growth come back quite sharply, but mine supply has taken a bit longer to catch up. And there's obviously that lag from mining the concentrate to that delivering that to the smelter. And I think that shipping disruption is obviously having a contributing factor there in terms of making that recovery of supply a bit more difficult and perhaps suppressing treatment charges as a result of that. In terms of metal price impact, I think that there's a general impact on sentiment that demand is recovering quite strongly and supply is struggling to keep up. And I think that's nowhere more evident really than in regional premiums, physical premiums for metals. Really, the high shipping costs make it very difficult for the global market to address some of the regional imbalances we're seeing in physical supply and demand. And you can see that with aluminium over the last few months in particular. We've seen big spikes in particular in Europe and the US for availability of spot physical metal. We can see actually that the surges in premiums for different metals in different regions is also a bit of a factor of where the inventories are for these metals. So using the LME as a bit of an indicator of that, you can see, for example, that we know the copper market's tight, but there's a lot of stock there in Rotterdam and Europe, and so premiums have been relatively well contained. Whereas in markets like aluminium and tin in Europe and in the US, there's very little metal there. And so these higher premiums are really reflecting the high cost of shipping that metal from places like Asia and difficulties and delays in doing that. In terms of when the shipping disruption could ease, well, I think that the Suez Canal blockage we saw a couple of months ago, the shipping industry is still dealing with the aftershocks of that by the impacts on scheduling and on port disruption. And I think the expectation among shipping analysts is that situation is going to make the global freight disruption worse in May and into early June. I think also this expectation that I think globally that people have that we're going to see this big demand recovery outside China, particularly as we move into the summer, is going to maintain pressure on shipping capacity quite heavily. And I think that really that disruption we're seeing in shipping may not ease substantially into perhaps the second half of this year or perhaps even longer. And I think that really is going to continue to support premiums, particularly regional premiums for physical metal over this period, particularly where inventories are at low levels. In terms of the long-term implications, I wanted to touch upon one point about just-in-time supply chains. So obviously the shipping disruption we've seen over the last year has really exposed vulnerability in some of these just-in-time supply chains. And I think that there's really an argument there for some of these companies with these more complex supply chains to hold more inventory there as a bit of protection against this kind of disruption happening again in the future. And I think obviously if you're having greater product inventories and a need to build up greater inventories in those supply chains, then that is probably a net positive for metals demand probably over the next year or so as well.